Hey guys, it's Jeff Trapp here with the Jeff Trapp Podcast, and I'm so glad that you've decided to join me today. It is March, tax season is in full swing. And if you have a business and a business tax return, your S Corporation partnership returns are due in just a few days on March 15th, 2024. So if you haven't compiled your data and your records and your books for your tax team, you may want to consider extending that tax return, right? Because you want to make sure that it's done correctly and you get all of the deductions available to you. Well, today I want to talk to you about something very, very important, and it is estate planning and taxes. And the reason that I want to talk to you about this today is, I set up my estate plan about 6 years ago, and now we're going through another process of amending our estate plan because we've had changes in our life, changes in our business. And if you have an estate plan, you probably have to go get it updated every, few years to make sure it's on track of where your life is headed and where you want it to go. And, estate planning is really, really important, especially if you have business, especially if you have assets, and also, especially if you want to pass on non-financial assets, right? Um, you know, One of the big main keys and drivers of setting up an estate plan is it avoids probate, right? So your assets would, instead of not going to the state that you live in, they would go to your heirs, your beneficiaries, your spouse. And, when it goes to probate or goes to the state, you can usually get those assets back, but it requires a lot of red tape and money to do that. So it's important that you set up an estate plan to make sure that your heirs and your beneficiaries control those assets. But one of the things I want to talk to you about today is, you know, you might have these financial assets, you might have these businesses that you want to pass down to your spouse, to your kids, to your grandkids, right? And those are monetary assets. But one of the things that you might want to consider is passing on non financial assets, such as, core values and the things that you value that are close to your heart. Maybe you value a certain university or a certain type of education or a certain non profit, or maybe you want to pass on certain values that you've trained your kids on. And if they, hit those values, they unlock certain levers and different things to be able to have access to those assets. I have a friend of mine, they have a trust in which um, it's basically a trust in which the kids and grandkids can take money out of that to go do something that's charitable. So whether that's build an orphan in Africa, or latrines somewhere, or go on a mission for their church, they're able to provide that to the kids or grandkids without having them use their personal money. So that's very, very interesting. But one of the things I want to talk about is the non-financial assets, right? I read a great book called Your Meaning Legacy, and it's about passing on these non-financial assets. I mean, as you know, there's basically two families kind of at the turn of the century in the 1900s. You had the Rockefellers and the Vanderbilts. Well, the Vanderbilts set up trusts and had a really, really great business. And what happened is they didn't pass on any of their values. So, when Gloria Vanderbilt was older, she sat down with her son, Anderson Cooper, and said, "Hey, the money's all gone. They had wasted and squandered it." Whereas the Rockefellers set up different trusts to pass down the wealth from generation to generation. They continue to have meetings together as a family on how the wealth is going to be spent and how it's going to be passed on. And they built in these different levers. So if you have somebody that's not adhering to the family values, they may not get anything. And so you don't have these kind of spoiled trust fund babies out there. So it's important to think about that when you set up your trust. But some other things you might want to think about, right, is reducing your estate taxes, right? One of the primary reasons for setting up different estate plans is to avoid federal and state taxes, to avoid an inheritance tax when you pass on. And there's different things that you can do. And I encourage you, when you work with your estate planning attorney, get your tax strategist involved. It's important to spend a few extra dollars to get the right estate planning attorney to make sure that these levers are built in as you continue to build your wealth. But also, you want to make sure you plan for income taxes for the beneficiaries. Um, you can do things that can reduce their income tax liability, right? You can spread uh, the distribution over the estate for several years. And that way, they're not pushed into those higher income tax brackets. Also, you want to consider capital gains taxes. If there are assets to sell, such as real estate, stocks, businesses, right? If you estate planning allows for the strategic transfer of assets that may appreciate in value, and there are ways that you can build in things to minimize or even eliminate those capital gains taxes. If you want to leave your assets to grandchildren, you have to think about the generation skipping transfer tax. So it's important to um, utilize this lever because there's an exemption limit of how much you can pass on to your grandchildren, but you can pass on a certain amount to your estate to them tax free. You want to make sure you maximize your lifetime gift exclusions of how much you can give away in your life to your family or charities or other things tax free. And then you want to ensure efficient distribution of the assets as well as plan for business succession. Who's going to take over the business? Is it going to be the kids? Is it going to be the grandkids? Or do you have a business partner? How are you going to fund that? Or are you going to sell the business? So there's a lot of different things that you can think about. And I encourage you when you sit down with an estate planning attorney, you make sure to ask them about taxes and tax planning. And if they're not talking about saving you money on taxes, you need to turn around and walk out the door because there are things that you need to set up as you grow your wealth and your legacy. And I guarantee you, your business, your life, and you are going to look a lot different 2, 3, 4, 5 years down the road. And you need to plan for these things and get them addressed. Now, if you're in the state of Texas, I've got a wonderful, wonderful estate planning attorney that we work with, where her values align with our mission, vision, and values of helping people save money on taxes and keep more of their hard-earned money. If you're out of the state, it's going to be important to ask questions and interview them, and we can definitely help you out with that. So if you found this episode helpful, please like, share, and subscribe. Even if you don't have a business and you're a wealthy person, you're going to want to make sure you get your estate plan figured out because, if you have kids, you got to figure out where the kids go, you know, your will, your advanced healthcare directive. There's a lot that goes into an estate plan. And, I'm going to drop a link below for our free tax playbook. Not only do we want you to save taxes, you know, past this life, but we want to have you save some taxes while you're still here working on your business. So, once again, I'm Jeff Trapp with the Tax Planning Pros, and this is the Jeff Trapp Podcast. And thank you so much for joining me today.